Welcome to a special episode of Develop Your Edge, where you will hear some of my favorite moments from past guests Annie Duke, Denise Shull, Marie Baiynd, and Raghee Horner. And I've gotten into some conversations with traders that have asked me, is mental edge really even a thing? What do you think, Denise?
It's definitely a thing. I'm going to step back for a second and provide some context. So there's really kind of two schools of trading psychology. One is the one that I learned in the 90s, the disciplined base, plan the trade the plan, take every trade in your plan, otherwise the statistics won't work out. Everyone tries to do that. Basically, no one can do it. Um, and the reason is, and by the way, if you try to do it and you can't do it, don't feel bad because it's not you, it's the way the human brain is built, which leads to the second school of trading psychology, which is really anchored in the idea that your confidence or conviction is the key. So this school is really only 15 or so years old, came from being able to watch the brain make a decision. Um, it takes psychological capital into account. Why? Because there are really two tracks to every decision. There's whatever your analysis is, whatever you know, whatever you've learned how to do, whatever that system is, whatever that plan for the trade is. But you don't make a decision on that. You never push the button on that. You push the button on how confident you are in that or how afraid you are that you're going to miss something. What the research shows is what causes you to do something is the feeling. So that's like so counterintuitive to what we've all been taught. But the truth is, it's like this huge opportunity to create an edge because you're working with your brain actually the way your brain works. Like you don't know it, but you're always predicting how something is going to make you feel. So you're looking at a trade, you're predicting it's going to work out or not work out. You're predicting whether you're going to feel good or bad about that. And it's like that dimension that causes you to make the decision. So that's an opportunity for mental edge.
Talk to us about dismantling, how you dismantle that hidden bias.
Oh my gosh. So yeah, I mean, that's really like that's kind of the whole book is kind of trying to get to that. And that this is what you just said. Like you can have a really good process. You can understand how to think about what are you investing in? What are the possible outcomes? What are the probabilities? You can calculate out what your expected value is. You can figure out what your downside exposure is, all of that stuff. But if the beliefs that are, sort of informing that process have some sort of flaws to them, we're going to be in really big trouble. It's kind of junk in, junk out. And this is where the cognitive bias problem happens, is that it's really hard for us to fix those cracks in our beliefs, the things that aren't quite right that we think are true, but it turns out they're really just kind of supporting the things that we want to be true. So the main bias that's really, really problematic, particularly in something like trading, is that because there's luck involved, we will reason about what we believe to be true about the world in a way that confirms the thing that we already believe to be true. So if we think that a certain strategy is going to work, the way that we're going to look at the world is going to be looking at that and saying, sort of like looking at all the pieces of information and kind of fitting it to our model, as opposed to changing our model to fit the new information. And once you add volatility into the equation, it becomes really problematic in the short run because you could have lost because of bad luck. So now this becomes really bad, right? Because it's like when you win, you're more likely to say, "Oh, I won because I was so smart and my model was so great and I'm such a great trader and look at how smart I am." And when you lose, it's like, "Can you believe that? I can't believe the market moved that way. Who could have known? That was really unlucky." And you sort of stick to your model. So the best way to actually address that is to get input from other people, but to ask other people in a very particular way. So I'll give you an example from poker because I'm sure that it will relate, right? If I'm trying to talk about a trade that I made in poker with somebody, the tendency would be for me to say to you, like, Anthony, let me ask you about this poker hand. Uh, Somebody raised in front of me, and I would tell you all the details about them, just like I would tell you all the details about the instrument I was trading and, what the market was doing and so on and so forth. So I tell you, like, are they tight? Are they loose? How have they been playing it? But they were winning or losing? How many chips do we have? All the facts that you need. And the usual way that I would do it is this person raised in front of me, and I looked down at ace queen. I was right next to them, and I raised back. What do you think of that choice? Right. So I tell you what the thing was that I chose to do. Um, but now what I've done is I've already given you the conclusion. So when you give me advice back now, it's going to tend to be to support the thing that I did. It's much less likely that I'm going to get your actual opinion of what I was supposed to do. If instead I say this person raised in front of me and I look down at ace queen, what do you think I should have done?
Oh,
Now I get to get your actual opinion. And honestly, it's
yes.
really hard to discipline bias without doing that. So you can imagine in your situation, you can say, I made this trade, the market did this. What do you think my response should have been? Even though you already made your
Exactly.
response, even though you already knew what you did, but like people just don't talk this way. They'll like tell you the whole arc of their day. They'll tell you what their, at the end of the day, what their P&L looked like. And then they'll ask for somebody to go back and help them. But that help becomes much less useful because you kind of pull them into your biases.
Remember, traders, micro treasury yield futures are now live at CME Group. Add these symbols to your charts: 2YY, 5YY, 10Y, and 30Y. To learn more about micro treasury yield futures, go to cmegroup.com. Ambry, if somebody asked you, what is your edge? What would you say?
My edge is really thinking about price like it's people in, you know, a UFC ring, maybe. So I think price and understanding what the traders are trying to do is a big part of my edge. But really, the way I formalize it is I use something called the OODA Loop. And so the OODA Loop, OODA, was developed by a colonel in the Air Force. His name is John Boyd. And he really developed it because a lot of pilots were crashing, and they were crashing because they did not know from a process perspective what they needed to do. And so the OODA loop says observe first. Then it says orient yourself to that observation. And once you've done that orientation, you can decide on a plan. And once you decide on that plan, you must act. And the moment you act, you turn yourself right back into the OODA loop. You observe everything post action. You orient post action. Then you say, do I need to make any adjustments? If you do, great. If not, you turn yourself right back into observe, orient, decide, act. So it's a constant motion of evaluation. Now, sometimes folks think, wow, that's like, wouldn't you be micromanaging? But you always look at it from a big picture. And so, one of my favorite things to do is look at monthly closes and weekly closes and those big levels. And then when we come into them and price begins to fight around that edge, somebody's going to win it. But people are putting their chips on the table, right? They're saying, hey, I'm making a bet that we move in X direction. I'm making a bet that we move in Y direction. But for me, I let the big betters do their betting, and I move in just when I see who's got the real edge. And I'm always doing that by saying, wait a second, what did we just do? Did we just get up over that VWAP and make a lower high, and now all of a sudden we're fighting at that VWAP? If I had real strength, I wouldn't be fighting at that VWAP again. I'd be moving to the north. So it tells me about the combatants on the stage and whether I can say, listen, I want to stay totally exposed in the position, or maybe I just want to take a little bit of profit here. Maybe I want to shift my size relative to what my combatants are doing on these larger time frames, the 4 hour, the daily, the weekly, the monthly. And so I think across the board, that develops a very controlled approach to the market. I'm not saying, here, it's done this, I'm just going to buy, and then, hey, that was my signal, I'm going to see what happens, and just wait for it to either hit my target or go into a stop. I'm constantly engaging. I'm saying, okay, I've observed that the traders are having a battleground up over this edge. If buyers were really, really strong there, would they still be battling with the opponents and all of that supply? The answer is no. They'd be driving right through them. And so my thought is, prepare by either taking some profit, lifting my stop, shifting my size, or saying, you know what, relative to everything else in my orientation event, this is still holding higher or this is still holding lower. I completely believe that once I became anchored in that OODA loop and focused only on the price action relative to its prior motion, because markets have price memory, right? The traders remember these prices. And so if I'm cognizant of that and I use the OODA loop relative to that, it really positions me well. My win rate has gotten much, much higher using that OODA loop process. It's golden.
And for me, that edge has been a combination of price, yes, but also volume, time, and volatility. I put those together and I think I've got X-ray vision on what the markets are telling me.
Expand on that a little bit. To give us an example of that.
Okay, fantastic. So price, I think for a lot of traders, price would be what? Price would be support and resistance lines. Price would be trend lines, which are rudimentary and very powerful. I think too many people leave those very rudimentary basic things in the dust because they're after some sophistication in their level of trading, which I think is always a pitfall that many traders fall into. So beyond price, so support, resistance, trend lines, major psychological levels, double zeros, single zero, whole number levels on a chart, basic price. Then we've got price-based indicators. So if it's a stochastic or any kind of indicator that's using that arithmetic of open, high, low, close, divided by, multiplied by, those are all price-based. And those are great. And I think a lot of traders stop there. But then we want to take the next step. And for me, the big eye-opening thing came from actually my floor trading buddies, because you guys know something that I think a lot of people forget. Size does matter. How many contracts are trading in a particular level? What kind of momentum did we see as we broke through a particular level? And so I think price is incomplete. Price doesn't tell the whole story. It tells the beginning of a story. It sets the story, but then volume starts to add the richness. What kind of participation? What kind of enthusiasm? To give the market a little bit more of a personal type of description. Then there's time of day. I know that I'm going to behave a certain way at a time of day, and I think the market behaves in different ways at certain times of day. So we add in that next layer of time, and then finally volatility. One of the things that I know, and a lot of traders know anecdotally, is that all 24 hours of a market are not created equal. Futures trading between 9:30 and 11:30 is a very different animal than futures trading between, say, the Asian close at 4 a.m. Eastern to, say, 7 a.m. Eastern, or 4 p.m. Eastern to 7 p.m. So different hours, different levels of volatility. You put all that together, and now you've really got a true picture of the market that transcends just price, where I think, unfortunately, a lot of traders just stop because they're not exposed to ideas that transcend price, because they're told price tells you everything, tells you a lot, but it doesn't tell you the whole picture.
If you enjoyed today's show, give us a thumbs up and hit that like button. If you didn't, hit the thumbs down and tell me why in the comments down below. Never miss an episode of Develop Your Edge. Hit that subscribe button. And if you want to send me a message, my DMs are open at Anthony Crudele on Twitter. And don't forget to check out Instagram at Anthony C. Crudele. That's a wrap for today. See you next week.